I ran the numbers on the spreadsheet calculator.
Mm-hmm.
So if we do velocity banking on that same $400,000 mortgage and go through the whole moving money here, moving money there, paying this, paying that,
paying the accountant to keep track of it.
Yeah. I got a spreadsheet in front of me and I'm spending a couple of hours every month just making sure I got all the moving parts going correctly. And oh, by the way, if I screw one up, I've probably screwed up a lot of my positive return.
Hello and welcome to X to Z Money Masters. Today we are talking about a topic that it's kind of taken the internet by storm. So if you get anything from this video that you truly like, or if you have further questions about, drop a comment, drop us a like, hit the subscribe button, hit the bell button for notifications whenever we do more videos like this. That way you and your friends can learn from our past experience and learn some things that you didn't learn in school about future finances and how to bridge that wealth gap. So what we're talking about today is velocity banking. It is using credit to pay off debt. So automatically it kind of sounds a little funky. The idea behind it is that you're going to be using a line of credit to help you pay off debt faster. In this case, we're talking about a mortgage. So I've seen this a lot. I've seen a lot of people talking about this on the internet, and it's taking off because it's usually in 30-second clips. This guy's talking about, if you really knew the way that the banks work, then you would do this, then, that way you can reduce your amount of interest, which in theory, it kind of sounds good, but there's always a catch somehow. And I think that, the newer generation is going to click on this and really, really take advantage of that, oh, I could pay my mortgage off in 10 years, 7 years.
Yeah.
It's even referenced at 3 years. So
Right.
it begs the question, where does it go? How does it work? And from Gen Y to Gen X, I just really need to ask you the question: velocity banking, paying off your mortgage with a HELOC. How does it work?
And I think if there was ever a subject for clickbait, this was probably the one, right? And so my hat goes off to those of you content creators out there that have mastered this skill. I don't know, Devin, if we've mastered it yet.
I don't think we're there quite yet.
We're kind of out here without much of a goal other than helping people. Right. We're really not after clicks, and I guess we are, to be honest.
Ultimately, just to spread the message.
Yeah, but we're really not about creating headlines to drive clicks. We're more about getting the truth on how to do things out there, and having communication between Gen Y, Gen X about all things money, right?
Yeah, because I'm not sure if this would have crossed your palate if I didn't bring it up, and because you'd never heard of it, right?
Well, I certainly had scrolled past it a number of times, and I want to shout out when Devin did bring it to my attention, and I actually sat down and started, really doing a deep dive into it. I do want to shout out to the Quack Brothers, because I think they did a good job on their video of outlining this initially, and so I just want to say congratulations to you guys. So the first thing I'll say about velocity banking is it is legit. It is a strategy that absolutely, when you pencil it out on paper and you work through all of the moving parts of it, it definitely works. In fact, there are a number of spreadsheets or calculators, whatever you want to call it, out there where you can kind of test the numbers. I have done that. I have jumped into a calculator spreadsheet that Devin provided me and ran through the numbers, and I'm happy to report to Gen Y that this thing is legit. Let me give a very brief explanation of what velocity banking is about, and this is a macro description of it. If you want more details and you trust us to provide those, comment down below, ask questions, and what we'll do is we'll reach out directly to you, answer your questions specifically, and tailor our answers to you. Okay, we buy a house for 400 grand, finance 320 grand for 30-year amortization. Okay, amortization is a fancy word for how long to pay off.
Right.
Okay, so when we say a 30-year amortization, we mean a 30-year loan. That's all that big fancy word means. Okay, so the idea is that we buy a house for 400, we borrow 320, we put a mortgage on it, and then we pay interest on that mortgage for 30 years. And Devin, it gets pretty big, right? On a typical scenario like 320, you might spend another 250 or so thousand just in interest over the 30 year. And for the first 5 years of the loan, you're pretty much only paying interest, right? And the concept here is, instead of working, taking your paycheck, put it in your checking account, write a check each month to your mortgage company, the idea is that you go out, you set up a HELOC, a home equity line of credit, If you can find a fixed rate on it, all the better. Most banks offer variables, but you want to look for that fixed if you can, because it's a control point. And the idea is that you direct your paycheck, all of your income sources, into the HELOC. You draw down the HELOC, you pay down the mortgage, and then as your income comes into the HELOC, you pay the mortgage and all of your bills out of that, okay? And then when your paycheck comes in again, the idea is you control your expenses, keep them as low as possible so that your income is upping the balance on the HELOC, right?
Right.
And the idea is that this strategy will allow you to pay off your mortgage much, much faster. In fact, before this video, I ran a standard $400,000 mortgage, 20% down, 7.25% mortgage, $50,000 home equity line of credit at 8%. You draw the 50 out, pay the mortgage down, repopulate the HELOC with your pay all your bills out of it. There's a little bit extra, and gradually that grows back to 50. You take the 50 out, pay the mortgage down, do it all over again. And the numbers prove that you pay that mortgage off in 10 years and 1 month versus 30 years. And the savings of not paying mortgage interest for 20 years is several $100,000.
Yeah, it's incredible.
It really is. Velocity banking is legit, folks, okay? And
However,
Gen Y, listen, you know, you guys have heard this before, right? If it sounds too good to be true, fill it in. It's
usually
probably too good. That's not the case here.
Okay.
Good news. Velocity banking isn't too good to be true. It's just a lot of work.
Yeah. And so good news is if you're already in the throes of doing this, you haven't messed up yet. So the difficult part for me is, you know, I see, like you said, there's a lot of moving parts here. I see a lot of risk being taken on by taking another loan, and it sounds to me like so personally, if I had, let's call it a 3% interest rate, and these are the questions that come up in my mind. If I had a 3% interest rate and my HELOC is at an 8 or a 9, maybe even a 10%, depending on, you know, factors, then does it still work? Is it just way less effective? Is it even worth doing at that point? And then another one is, what if I don't have equity in my home to get a HELOC? So I may be jumping the gun a little bit and pushing myself down the road a little bit further.
But these are the kind of questions we want to encourage you. If you're out there, if you're sitting in you know, Baltimore, Maryland, right, and you got a mortgage on your house, and you know, you're wondering, does this actually work for me or not? Throw a comment down below or DM us with the specific numbers, man. What your balance is, what your rate is on your mortgage, and what your local bank HELOC rate is, and we'll plug the numbers in and tell you whether it works or not, right? But let me answer Devin's question specifically. First off, you cannot take out a home equity line of credit if you don't have home equity. So if you just bought your home in the last year or two and your prices are declining a little bit, it's eating into your equity. You may not have enough equity to take out a home equity line of credit, right? So most home equity line of credits are going to be a little bit of a challenge for anybody with a new home or in their first year or two. But if you've owned your home a few years or so, you should have adequate home equity in your home to be able to draw out a line of credit. Okay. And then your second question was, the lower interest rate.
Yeah, the interest rate variation.
Yeah, I suspect that there is a margin between the two rates where there's failure. Okay. And I suspect if your mortgage is 3% and HELOC is 5 or higher, meaning it's a 2% gap, I suspect the numbers aren't going to prove out at the bottom line quite as well. But here's the good news. If you happen to like and follow X to Z Money Masters, is you literally can comment or message us and we'll answer the question for you for free. You don't even have to pay anybody for that guidance and advice. We're just looking out, trying to help people.
May even do a video on it.
Yeah. But where you're really at with this, the idea is that you take a mortgage out today, which might be 7.25. The HELOC might be at 8, and the numbers do work, right? You pay that house off in 10 years. But Devin, I got to share something with you, man. And this is what's cool about, I think what's cool about our channel is that You're right. I'm on TikTok every day, folks. But I would have scrolled right by the Quack brothers and others talking about
Right.
this because I have a degree in finance and I have an extensive background in economics and finance. And so most of what I see online are old ideas that someone's trying to get clickbait with.
Right.
And, I kind of know numbers and finance, and I'm not bragging. I'm just saying I just don't really pay attention to that, okay,
Right.
on TikTok. That's not what I'm on TikTok for. But when I saw this video and I took the time to actually sit down, listen, and then model out numbers myself, like I said, it's valid. But it reminds me, Devin, of a throwback idea that I think is better.
Okay.
I think it's better than velocity banking. And it's the simplest strategy. It works the same, but you don't have to open up accounts, have spreadsheets, make sure you pay this here, do that there. And that is this old idea: make one extra mortgage payment per year on your mortgage. And I ran the numbers on the spreadsheet calculator.
Mm-hmm.
So if we do velocity banking on that same $400,000 mortgage and go through the whole moving money here, moving money there, paying this, paying that,
Paying the accountant to keep track of it.
Yeah. I got a spreadsheet in front of me and I'm spending a couple of hours every month just making sure I got all the moving parts going correctly. And oh, by the way, if I screw one up, I've probably screwed up a lot of my positive return. However, if I make one extra mortgage payment per year on my mortgage, guess how fast I pay the mortgage off? Same scenario. Instead of 10 years and 1 month, gets paid off in 10 years and 4 months.
Oh, well, that's way slower.
Right. And think of the complexity. I have to write one extra check each month. Right. I don't have to move money. I don't have to look at interest rates. I don't have to take out another loan.
The number one thing that I see with the advantage of that, and you brought this up whenever I brought the idea up, and we kind of ran through the numbers, and I didn't even think about doing that. I'd heard that, but to me, this being the Gen Y in me, it was an old concept. I didn't really pay attention to it. Some of those proven concepts don't necessarily have the same kind of ring in my ears, so I never really thought to do it to my own mortgage. I'm going to start now, but I just for whenever I hear that make an extra mortgage payment, I mean, I'm thinking of a $400,000 house at a 7.25% interest rate. It's looking at what, $3,000 a month, maybe less, maybe more. So I don't want to take out $6,000 in 1 month to make that payment. But then you explained that you can just make an additional $100, $200, $300 a month every month, and it goes directly into your mortgage. I wasn't aware that you could do that.
Yeah. Let me give you our viewers a couple of pointers. Let me give you a couple of ideas as well to be thinking about on this. First off, you literally can write a check out for an extra mortgage payment. Like let's say in July of each year, you just make 2 mortgage payments, right? Mm-hmm. But here's what I want to have you do. I want you to pick up the phone and I want you to take your mortgage statement out, look at the 800 number for customer service, and I want you to give them a quick call. Mm-hmm. And I want you to just simply say, hey, I want to start making one additional mortgage payment on my mortgage each year, and I want it to apply to the back end of the loan. That's important, okay? How do I do that? Ask the customer representative at your mortgage company, how do I do that? Here's what they're likely going to tell you. When you write out that second mortgage check, down in the memo section, you just simply put additional payment applied to back end of loan. That's it. That's all you do, okay? And in theory, the person processing that check at the mortgage company will see that and will apply it to the back end of the loan. Because why? Because one mortgage payment's already been made.
Right.
So when they pull it up in this system to attach it, it's an addition. They're going to say, well, the mortgage has already been paid. What do we do with this? Typically, they might apply it to next month's mortgage.
Right.
But you want it applied to the back end of the mortgage.
The principal.
Yes, to the principal, right? So that's one way to do it. Now, another thing, to Devin's point, let's say your mortgage is $3,000 and you don't want to write 6. You can do $300 a month for 10 months out of the year and still make the payment.
Right.
And then what you do is you write on your check. Okay, so say your check is $3,000, you send in $3,300. In the memo section, please apply additional to back end of loan.
I'll have to look up because I hate to tell you, not very many people use checks anymore.
Well,
I'll have to look into that. Maybe we do an additional video, or maybe we get an update on that. But I'm sure there's still a way to pay a principal amount each month. And customer service will be able to easily help you out with that. There's no way in my mind that the bank is going to be like, nope, we don't want your extra money. There's no shot.
So back in the day, there used to be language in a mortgage note that didn't allow some mortgage notes that did not allow you to prepay the mortgage without a penalty. Okay. Why? Because the banks, when you take out a mortgage, the bank or the mortgage company sells that to a servicing company.
Right.
And they are able to get a higher premium for that sale if the mortgage is guaranteed to last 30 years.
Right.
If it can be paid off early, the bank buying it has to factor in early payoff and the bank gets less premium. Make sense?
Absolutely.
Okay, so that's a nugget of information you just picked up by watching us that you're not going to find anywhere else on the internet because very few people know that.
And to underline that, I understand that process very well, and you may not. And the reason why it would be more beneficial for them to have the lifetime of the 30-year mortgage rather than a 10-year mortgage is exactly what we're trying to circumnavigate here with Velocity Banking and making the extra payment. And that is the lifetime of the loan is going to profit them much more interest payments than it will if you do it a 10-year and pay it off earlier. So therefore, the company acquiring the debt from the bank is going to profit more. So you gain. It's just a better overall yield for them.
Yeah. Now, in case I got somebody watching out there that is real sharp on economics and finance, they're standing there yelling and screaming at the screen right now, saying, "So let me correct something." That would be in the case of a flat interest rate environment or a declining interest rate environment. If rates are going up, the bank wants you to pay that loan off much, much faster because they want to take the money and re-lend it out at 8% instead of at 3%, right? Just a little adjustment there. And I want to come back to one other thing, and that's checks. Folks, I know, and I don't pay my bills with checks. Just to be clear, I go into my bank, I have bill pay. But you know what? Every time you make a bill payment online, there is still a memo section.
Yeah.
So in the memo section, just put in $3,000 for April mortgage, $300 extra. Please apply to back end of loan. And your mortgage company should do that. The reason I like you to call is sometimes customer service can put a note into your file, any additional payment to be applied to back end, and then whoever's processing it just kind of sees that, and it tends to happen a little bit more often accurate.
Okay.
Make sense? So make it one additional payment per year on your mortgage. You'll pay it off much faster than the 30. You'll pay it off a little bit longer than Velocity Banking, but you're not moving money. You're not doing this. You're not doing that. You're not trying to manipulate interest rates. You're just sending one extra bill each month.
I've gotten scared now.
You got me on that. Yep.
But I mean, I think the short and curlies of it all is, Velocity Banking. It sounds really, really great. Like it's got that snap, that pizzazz.
Sizzle.
It sounds great, and it's something that is pretty confusing. So it's easy for these gurus out here to take that Velocity Banking and then throw it in your face, especially being Gen Y, Gen Z. I mean, and it's getting harder and harder to maintain that middle class. I mean, everybody's talking about it dissipating and things like that, but being able to get that hack that can change your life, that can pay off your mortgage in 3 years, 10 years, pay it off 20 years in advance, save you hundreds of thousands of dollars in interest. That's gonna sell because that's, like you said, that sizzle sells. But the brass tacks is, I'm a victim myself. I should have paid attention whenever I heard, pay that extra additional mortgage payment per year. And those tried and true methods are still going to be tried and true. If they've been proven since the 80s, the 70s, the 60s, the 30s, they're probably still going to hold true today. They may not be as fast as Velocity Banking, but clickbait sells and it makes them money, and it works pretty effectively the same. Now, it may be a good practice for people who have more expendable monetary income and things like that. It might be something that if you find yourself making $300,000 a year and you're just putting your money away and you're putting it into a 1% or a 0.1% high yield savings or something of that nature, then maybe it's effective for you to take out that HELOC and really double down on paying your mortgage off in 3 years because you have the liquid asset to be able to do something like that. But for the layman who's making $5,000 or $3,000 a month, it may be difficult for you to bear your finances. I know I've been there, especially in my early 20s, bearing your finances down, making that 3,000 last throughout the entire month while making that mortgage payment. It's kind of scary sometimes. And just making that extra payment is, you don't have to. You can always just say,
Yeah,
what, this month,
yeah.
I need the extra $300 for my car
Right,
payment.
right.
But with a HELOC and Velocity Banking, you got to pay. So it wraps you up, it chains you, it cuffs you to that line of credit. And that's not what we're here for. We're here for easy things that can help bridge that wealth gap and move you forward with velocity, not with headlines.
Yeah, exactly. You listen, again, it's legit. Velocity banking is legit. And if you want to build the spreadsheets and track it and do it, by gosh, do it, because you're going to be in a better financial position in a decade than you would be if you don't. However, we can eliminate all the hassle, time, and constraint by simply making one additional payment per year. Got any questions? You like this kind of information? Like us, follow us, all of that sort of thing. We are not about headlines and clickbait. We're about telling you the numbers. And by the way, if you disagree with anything we've said, put that in the comment too. Let us know. Hey, if we're missing some valid point, let us know about that. Devin, I do, for sake of clarity, I do want to throw in one additional minor league point, and that is there is a payoff difference if you're making one extra payment each year in full versus a couple of hundred a month. Because if you think about it, if you make the additional mortgage payment at the beginning of the year, it has more value to you than if you make it at the end of the year. And when you spread those payments out, you're not getting the full impact to the bottom line. It's spreading it out a little. So I can imagine that where the payoff might have been 10 years and 4 months, if you're doing 300 a month, it might extend it out to 12, 13. You're still coming out way ahead of a traditional mortgage. But again, there's a lot of moving parts in all of this, but the end of the day is this. Oh, and I got one other, I'm sorry, folks. I'm a detail guy, I guess. One other thing, before you do any of this, speak to your CPA if you have one. If you don't have a CPA, take a look at your tax filing for last year that you did, because what you want to be careful of is there's a lot of write-offs in the mortgage process. And sometimes the write-offs that you have are very, very valuable. And so just make sure you factor that into this equation, because some people are not in any hurry to pay their mortgage off because they need the write-offs to come with it. So take that into account as well. Small detail.
Yeah, absolutely.
Small details.
I just want to backtrack with you making the payment at the beginning of the year versus throughout the year and at the end of the year. The reason why that is because it's effectively doing the same thing that this velocity banking is doing. And at the beginning of the year is when your amortization is built for the year. So you pay it off at the beginning of the year, you lower your overall balance, therefore lowering the amount of interest that you pay. So it can stack up a little bit more if you're making that payment January 1st versus December 30th.
Yeah.
So it makes an impact to do it a little bit earlier because it lowers the amount of overall interest you pay for that year, therefore leaping you forward just a little bit faster. But he's right. I think that, even if you're making that payment at the end of the year, you're still putting yourself in a situation that, 15 years is very attainable to pay off your home.
Yeah. One other thing real quick, and that is this. If you can't do any of this, money's a little too tight, round up your mortgage payment.
Yeah.
If your mortgage payment is $1,178, send in $1,200. Okay. Just pay down that principal. Believe it or not, that may reduce your mortgage from 30 years to 27 years. But that's 3 years puts money in your pocket, folks.
Absolutely. And if you look at the grand scheme of things, $50, that's 10 days worth of Starbucks, maybe even less. It's something that simple that can provide you 3 years. If you think about it, 3 years at the end of your loan, you know how many days of Starbucks that is?
And you shouldn't be buying Starbucks anyway. You should be making your own coffee, taking the difference and putting it in an S&P 500 index fund over the course of your life. It literally could make a difference of over $1 million in your account versus a Starbucks coffee every day. Spending money, $5, $6 on a cup of coffee every day has got to be the dumbest financial decision you could possibly make for you and your family in your future. We should do a video on the impact of buying a Starbucks cup of coffee on your net worth in retirement. We should do that video. It is absolutely stunning.
I was about to say, maybe this is a little bit of foreshadowing. I don't know if you know the name of it, but it's called the $1,000,000 Cup of Coffee. And it's a proven statistic that many other finance people have portrayed. And I think we should do a video on
No
that.
kidding.
Absolutely.
So what I'm
There's a
saying,
name
there's
for it.
already a name out there
It's
for
called
it.
the $1,000,000 Cup
See,
of Coffee. It was
Gen X. I don't pay attention to this stuff online.
It was hands down because during 2020 was whenever I really started my deep dive into financials. Like I've always been a very money minded person, and I've been taking care of my P's and Q's, but really starting to invest and find real estate attractive and things like that. That's when I really took a deep dive. And the first video that I watched on how to change your life in the fastest way possible was the $1,000,000 Cup of Coffee. And it is an origin story for me, so I would love to do a video on it.
Let's do it, because the numbers are absolutely shocking.
It's insane.
You cannot look at the numbers. I promise you, if you look at the numbers, you will not go back to Starbucks tomorrow. You'll do what I did. You'll buy a coffee machine that grinds the bean and then brews the coffee, and it makes the coffee 10 times better than Starbucks. And you can make it for 50 cents a cup.
Yeah.
And then take the $4.50 you would have spent, put in an S&P 500 index fund, and folks, you will have $1 million in the bank when you retire. I promise you the numbers work.
It'll make you want to puke. The first time that you see it, you're like, oh man.
Yeah. Can literally make a difference of well over $1 million by retirement.
And that's the ultimate thing that we're trying to get across here is finance is not that difficult. It just has a lot of buzzwords and a lot of keywords that people just aren't used to hearing, and they don't know what they mean. The vernacular is different. I don't know about that. I can't see myself there. I'm not there yet. I don't have $100 in my bank account. How am I going to save to $1 million? That's where you're wrong. You've already lost half the battle by thinking that way.
Yeah.
Finance is easy, and you can make these small incremental steps and stay dedicated to the cause. Whether it's $1 a day, a penny a day, you can make a difference in your life, and we're here to help you make that happen. Welcome to XZ Money Masters.
Thanks, everybody.